Welcome back to 8-Minute Finance, the channel that takes the most complicated topics in money, crypto, and investing and turns them into easy, entertaining, and culturally relevant breakdowns. I'm Ted, and this page is for educational use only. I'm not a financial advisor. My mission is to teach in a fun, relatable, and engaging way. Today, we're tackling a big one. What are stocks? The bedrock of most investing conversations and the starting point for almost every wealth-building journey. Think of a stock as owning a tiny slice of a company, like your favorite pizza place selling pieces of the restaurant instead of just slices of pizza. Imagine you and your friends each buying a piece of that shop. If the shop expands to 2 new locations, your slice of ownership becomes more valuable. But if the shop starts burning pizzas and losing customers, the value of your slice goes down. The more slices you buy, the more say you have in how the kitchen runs. And in this analogy, the kitchen is the company itself, the place where the magic happens. A stock is a share, literally a small percentage of the company's total value. If the company grows, your slice becomes more valuable. If the company struggles, your slice shrinks. Same pie, just smaller, and nobody likes less pizza. And just like in real life, everyone wants that bigger, tastier slice. This is how everyday people, not just billionaires, can own a piece of giants like Apple, Amazon, or Tesla. You don't need a fortune to start, just a few bucks, and you can technically say you own part of Apple. You could be walking into an Apple store looking around and saying, "Yeah, I own this." Well, technically 0.00002% of it. Sounds cool, until someone asks how many shares you've got and you have to admit it's just one. Still counts. Stock prices constantly change every second based on supply, demand, performance, and market mood swings. Sometimes it's all green and happy, sometimes it tanks, like Twitter after a bad celebrity take. The numbers are alive, constantly moving, and that's part of the thrill and the challenge. Here's where it gets interesting. Stocks don't just exist in a vault somewhere. They're constantly being bought and sold in places called stock exchanges. Think of it like the NBA for companies. You get drafted, that's the IPO. You play in front of a crowd, investors. And your stats, stock price, can go up or down every game, trading day. And just like a player's career, a company can have hot streaks and slumps. When you hear the market is up or Dow Jones is down, that's basically the scoreboard. But unlike sports, there's no off-season. Trading happens every weekday and somewhere in the world, 24/7. A company's stock price moves based on supply and demand, which is influenced by a mix of earnings reports, breaking news, interest rates, or even a single tweet from Elon Musk. Remember the time Dogecoin spiked because of a dog meme? Same principle. Sentiment drives movement. And here's the plot twist. Stocks can make you money in 2 ways. First is price growth. If you buy a share at $10 and it climbs to $15, you've made a profit if you sell. Second is dividends. Some companies share a piece of their profits directly with shareholders. It's like getting a mini bonus just for holding their stock. Not every company pays them, but for the ones that do, it can add up, like a loyalty reward for being part of the team. Dividends are so important. We're dedicating our next video to breaking them down. So, to recap, stock prices move because of supply and demand. You can earn through growth, dividends, or both. But the market isn't a straight line. It's more like a winding road with plenty of speed bumps. In the next act, we'll tackle the big question. Is investing in stocks a smart move or just a fancy way to lose your money? Now that we know how stocks work and how they're traded, let's face the big question. Is investing risky? The short answer? Yes and no. If you treat the stock market like a slot machine or a scratch-off ticket, chances are you'll lose money. But if you approach it with patience, a plan, and realistic expectations, history shows it can be one of the most powerful wealth-building tools out there. Think marathon, not sprint. Here's some perspective. If you invested $1,000 into the S&P 500 in 1990 and simply left it alone, you'd have over $20,000 today. That's without picking individual winners, just riding the wave of the overall market. Think of it like getting in on a mixtape before the artist blew up, then holding on through the ups and downs until they're selling out stadiums. Sure, there were rough years in between, but the overall trend? Upward. This is where the strategy matters. Long-term investors ride out the dips, trusting that over decades, the market trends upward. Short-term traders, on the other hand, try to time those ups and downs for quick profits. But that's a skill game, and even the pros take losses. Either way, you need discipline, because emotions are the biggest portfolio killer. One bad decision made in panic can undo years of growth. So ask yourself, are you the patient type or the thrill-seeker type? And if you're thinking about starting, there's a safe way to dip your toes in. I've linked a stock trading app in the description that gives you free shares just for signing up. No deposit required. I've done it myself, and it's a no-risk way to experience how owning a stock feels. You'll watch the price tick up and down in real time, and that little heartbeat in your portfolio can teach you more than a book ever could. Free is free, and it's a fun first step. Bottom line, stocks are risky if you gamble, but powerful if you invest smart, stay patient, and think long-term. That's how wealth is built. One smart move at a time. It's not about getting rich overnight, it's about building a foundation that lasts. Here's the thing, everything we've covered today isn't just for you. If you've got kids, nieces, nephews, or even a little cousin who's always asking questions, this video can be their starting line. Financial literacy isn't taught enough in schools, so why not start the conversation now? The earlier they understand this stuff, the more options they'll have later. Explain stocks to them the way you just learned here. Keep it simple. Keep it relatable. If they can understand how a video game's point system works, they can understand how stocks work. If they can track high scores in Fortnite or build resources in Minecraft, they can grasp ownership and value. Trust me, planting this seed now means they could be investing smarter than most adults by the time they're 18. And if you want them, or you, to take the next step, the link in my description will give you free stocks just for signing up to a trading app. No deposit, no catch. It's a fun way to get started, and who knows, that free stock could be their first real investment win. Sometimes that one little share is all it takes to spark curiosity. So, here's your homework. Have them watch this video, then our next one on dividends. That's where they'll learn how some companies pay you just for owning their stock. It's like planting a money tree early and watching it grow together. And remember, the more you understand money, the more control you have over your future. If this video helped you, do me a favor. Hit like, drop your thoughts in the comments, and subscribe so you don't miss the next one. Let's make money make sense together and pass that knowledge forward.